For investment analysts navigating the noise of financial markets, few data points are as catalytic as company earnings. Each quarter, the release of financial results offers a pulse check on corporate health, consumer trends, and macroeconomic conditions. But in a sea of ticker symbols and expectations, how does one organize and interpret it all? Enter the earnings calendar, a deceptively simple tool we've just added to our interactive data hub on the investmentanalyst.com that, when used well, can guide market anticipation, sentiment analysis, and strategic positioning. This video, unpacks how a company earnings calendar works, using the snapshot from our data hub as a practical lens, and explores how it can become a core part of an analyst's toolkit. An earnings calendar is more than a schedule. It's a structured table of expectations versus reality. Each row typically represents a company reporting earnings on a given day, and each column helps tell the story. EPS, earnings per share, a measure of profitability on a per share basis. This figure is often the star of the show. Forecast EPS, the market consensus estimate that analysts expect. The delta between actual and forecast drives price reaction. Revenue, total sales reported during the period. Forecast revenue, street expectations. Again, surprises here can sway valuations. Market cap helps frame the scale of the company. Small cap versus mega cap responses vary in magnitude. Released indicates whether the earnings are already out or pending. Country and impact, flags and star ratings help contextualize the economic relevance of each event. In the April 17th example, companies like BYD, Cinepec, and ABB from Asia and Europe are listed alongside major US names like American Express, Blackstone, and Ally Financial. Each row provides not just data but directional cues. Take BYD, the electric vehicle manufacturer from China. It reported EPS of 5.16, significantly above the 3.86 forecast, with revenue similarly smashing expectations at $274.85 billion versus $253.88 billion. That's a textbook beat. For a $51.8 billion market cap company in a growth sector, this likely catalyzed upward momentum and possibly influenced sentiment across the EV space. Contrast that with Cinepec, which missed both EPS 0.07 versus 0.10 and revenue. Despite its $76.3 billion market cap, the miss might raise concerns about commodity pricing or downstream margins, insights relevant for analysts tracking the broader energy complex. And then there's American Express, a bellwether for consumer spending. Its EPS beat 3.64 versus 3.56, alongside a modest revenue beat, suggests consumers are still spending, and perhaps more resilient than feared. That's a macro takeaway baked into a micro signal. Earnings calendars are not just passive information repositories. They serve as active operational tools for investment analysts. Their utility extends far beyond simply observing dates and numbers. In skilled hands, they become instruments for forecasting, strategic positioning, and model refinement. One primary use is in screening for volatility. Analysts can identify high-impact events, often marked with 3-star ratings, and anticipate significant price movements, especially in companies known for delivering earnings surprises. These events are not merely informational, they are, potential catalysts that may lead to meaningful revaluations. Earnings calendars also play a vital role in guiding sector rotation and benchmarking. When multiple companies within the same sector beat or miss expectations, it may signal the need for a reassessment of relative valuations or even a thematic repositioning of portfolios. For instance, a strong earnings beat from BYD might suggest renewed momentum in the electric vehicle sector, prompting a strategic shift, while an inline result from ABB could affirm the stability of industrials, reinforcing their appeal as defensive plays. In quantitative and event-driven strategies, the data from earnings calendars is essential. Earnings surprises often feed into models that exploit patterns such as post-earnings announcement drift, a PAID, or earnings momentum. Companies that consistently exceed expectations tend to exhibit short-term outperformance following their reports, providing actionable signals for tactical trades. Lastly, many fundamental analysts use earnings calendars to support calendar-based modeling. By systematically tracking earnings results and deviations from forecasts, they build earnings matrices that evolve over time. These models enable bottom-up aggregation, where individual company outcomes inform sector-level insights, which in turn help shape macroeconomic views. In this way, the earnings calendar becomes a foundational component in both granular and big picture investment analysis. During earnings season, market narratives often hinge on the data revealed in corporate results. The earnings calendar brings order to this flood of information, providing analysts with a framework to prioritize their focus and identify early signals of broader shifts. It acts as a map through the noise, helping analysts spot inflection points before they're fully reflected in market pricing. Consider the questions that naturally arise as earnings reports roll in. If consumer discretionary companies are consistently beating expectations, it could indicate resilient consumer demand, suggesting strength in household spending despite macro headwinds. Conversely, if industrial firms are routinely missing revenue targets, it may point to emerging weakness in global trade or supply chain pressures. And when financial institutions beat on net interest income but issue cautious forward guidance, it could highlight underlying concerns about interest rate volatility or credit conditions. These observations transcend individual stock performance. They offer thematic insights that influence broader sector allocations and inform top-down macro views. In this way, the earnings calendar becomes a lens through which analysts interpret not just company-level developments, but the evolving contours of the entire market landscape. As valuable as earnings calendars can be, they are no replacement for rigorous analysis. Their utility lies in directing attention, but not in delivering definitive answers. There are several important caveats that analysts must keep in mind when interpreting the data. First, not all earnings beats are created equal. Companies often manage expectations deliberately, guiding consensus lower in order to exceed it when results are announced. These engineered surprises can generate short-term excitement, but they don't necessarily reflect fundamental strength. It's the analyst's role to dig deeper and assess the true quality of the earnings. Second, market reactions to earnings are frequently driven by short-term noise rather than underlying fundamentals. Sentiment, positioning, and the dynamics of option markets can all distort how prices respond. A miss may be shrugged off if pessimism was already priced in, while a beat might be sold if expectations were too high. Finally, the headline EPS number often tells only part of the story. Many companies report non-GAAP figures that strip out various expenses or one-time items, which can mask deeper issues. To gain a clear and accurate picture, analysts must look beyond the surface, examining reconciliation tables, reviewing footnotes, and evaluating whether the adjustments truly reflect operational reality. In short, earnings calendars are starting points, not conclusions. Their real value emerges when used alongside thoughtful, context-rich analysis. A well-organized earnings calendar is a map of market catalysts. For investment analysts, it's not just a schedule, it's a filter, a signal, and a planning tool. Whether you're updating valuation models, preparing trade ideas, or aligning macro theses with corporate data, the earnings calendar is foundational. By understanding not just what the numbers say, but how they're positioned relative to expectations, an analyst can avoid reacting to noise and instead harness earnings season as a strategic edge. In short, it's not just about the data, it's about how and when you interpret it.